I won't be wrong if I said crude oil futures is one of the most actively traded contracts on the multi-commodity exchange. This is because you can trade crude oil with as little as 20,000 rupees. But when it comes to retail traders, most of them miss out on the price action because they don't know how to read and where to read the inventory data. Inventory data pertaining to crude oil. I will discuss the inventory data and much more in this video. But before that, let's quickly understand crude oil futures and the contract specifications. Of course, the basic assumption here is that you're already comfortable trading futures and options. If you aren't, then please do check out our series on futures and options. Crude oil futures has two variants on MCX, the crude oil and the crude oil mini. The price that you see on your ticker is for 1 barrel of crude oil. Most of you may not know this, but 1 barrel of crude oil is equal to 159 liters. The lot size for crude oil is 100 barrels and the lot size for crude mini is 10 barrels. This translates to a contract value of 5.8 lakhs for crude oil and about 58k for crude oil mini. Of course, this is keeping today's price in perspective. The margins are same for both crude oil and crude oil mini, which is about 34.25%. Of course, this can also change from time to time. At 34.25% margin requirement, the margin amount for crude oil is 2 lakhs and crude oil mini is 20,000 rupees. Please note, you don't have to transfer money separately to your commodities account to trade commodities. The regular fund transfer you make for your trading account can be used for both equities and commodities. This is of course a big advantage for commodity traders as it saves a lot of time. Unlike gold and silver, crude oil is not physically settled, it is cash settled. The expiry is on a monthly basis. When it comes to option contracts, options are available on crude and not on crude mini. Of course, the regular option chain analysis that you would do can also be done on crude oil. Indian option markets opens at 9 a.m. and closes at 11:30 p.m. or 11:55 p.m. based on the US daylight savings. As a trader, you need to pay attention to the closing time of the market. Also, as a commodities trader, you need to be aware that there could be days where NSE and BSE could be closed for a holiday, but MCX could be open. In fact, there could be days where MCX is closed during the morning session, that is between 9 a.m. to 5 p.m., but open during the evening session, that is between 5 p.m. to 11:30 p.m. For instance, 14th March was a holiday across all exchanges, that is NSE, BSE and MCX. However, MCX was open for the evening session, that is between 5 p.m. to 11:30 p.m. So please do pay special attention to this, especially if you have a position in crude oil or any other commodity for that matter. Unlike gold and silver, you can hold crude oil positions till expiry. There is no need to close the position before the tender period. Tender period for any commodity starts a few days before the expiry, and if you hold the position during tender period, it implies that you have an intent of taking delivery of the commodity. Now here is where it gets a little tricky. If you wish to hold the contract till expiry, then the margins will slowly start increasing by 5% every day from the start of the tender period till expiry. So the margin requirement increases in these contracts leading to expiry. Because of this increased margin requirements closer to expiry, the trading activity shifts from the current month to next month contracts, and therefore the liquidity starts to dry up. So if you want to be an active trader in crude oil, then be aware of when the expiry is and perhaps choose the contract wisely. This is not just true for crude oil and crude oil mini, but also true for natural gas and natural gas mini, which we will also talk about later in this video. With the contract specs out of the way, let's concentrate on what really moves crude oil. Broadly speaking, there are three important points that you need to pay attention to. The relationship between crude oil and the US dollar, the crude oil inventory data and the outcome of OPEC meetings, and thirdly, geopolitical play, especially in oil-producing countries. Let's talk about the USD first. Like any other commodity, crude oil and USD also share an inverse relationship. A strengthening US dollar tends to push crude oil prices lower. Likewise, a weakening US dollar tends to push the crude oil prices higher. Think about this. Generally speaking, if the US dollar is strengthening, That means rupee and a basket of other currencies is weakening. As of recording this video, rupee is roughly around 86 rupee to a dollar. Now assume USD INR goes to 100 rupees. That means to say the US dollar has strengthened and rupee has weakened. What do you think will happen to the prices of crude oil? Of course, crude oil tends to become more expensive. The increased cost of crude oil makes crude oil less attractive for foreign investors and the domestic oil marketing companies. This leads to a lower demand for crude oil and therefore the inventory level goes higher, which in turn lowers crude oil prices. So as a trader in crude oil, you need to watch out for factors that influences the movement of USD and base your decisions on that. Of course, when it comes to crude oil, the big data point to watch out for is the inventory data, which is released every Wednesday. The idea behind the inventory data is simple. If the inventory data is less than what is expected, that means there is a higher demand for crude oil, hence the crude oil price is expected to increase. If the inventory data is more than what is expected, that means there is lesser demand for crude oil and hence the crude oil price is expected to decrease. There are two agencies that releases the inventory data, the American Petroleum Institute called API and the Energy Information Administration, also called EIA. The release of inventory data by both these agencies falls on a Wednesday India time, and that's the reason why you will find a lot of volatility on crude oil futures on Wednesdays. API inventory data comes out on Tuesday 4:30 p.m. US time, which is roughly 2 a.m. Wednesday morning in India, which is well in advance before the 9 a.m. MCX crude oil market open. So if you're trading crude oil on Wednesday morning, do check for the latest API inventory data released the previous night. EIA inventory data comes out at 10:30 a.m. US time on Wednesday, which is 8 p.m. India time. Do note, when EIA releases its inventory data, it is 8 p.m. India time and MCX market is still open. You can check the inventory data on many websites, including the official websites of API and EIA. But I personally prefer to track this data on investing.com. Here is a snapshot of the most recent API inventory data. As you can see, there are 3 data points here. One is the actual previous data. Second, the forecasted data for this release. Third, the actual data. As you can see, the analysts had forecasted an excess supply of 1.17 million barrels. But the actual data suggests the excess supply was 4.5 million barrels. Clearly, excess supply is an indicator of lower demand for crude oil, and this is not a good news for crude oil traders. Please do pay attention to the release time of the data. This is at 4:30 p.m. US time, which is roughly about 2 a.m. India time. EIA crude oil inventory data is released at 10:30 a.m. the following day, which still happens to be Wednesday 8 p.m. when MCX is still open, which means to say that traders on MCX can capture this data point live and readjust the prices if required. As you can see, the EIA inventory data released on 19th March at 10:30 a.m. also indicates an excess supply, both in terms of forecasted and the actual data. And as you can see the intraday chart, this is the reaction of crude oil on March 18th and 19th. By the way, on investing.com, you can also check the historical inventory data released by both API and EIA, which I think is quite interesting. But please be aware, there could also be days where the data points from API and EIA won't match. In fact, they could be opposite. In such cases, as a trader of crude oil on MCX, it makes sense to pay more attention to the inventory data released from EIA because EIA data is more recent and Indian markets have enough time to readjust to prices. Now, you may be wondering what influences the inventory data in the first place. Well, this is where OPEC comes into picture. OPEC stands for Organization of Petroleum Exporting Countries. Think of them as a big cartel controlling the production and supply of crude oil, which of course influences the crude oil prices in international markets. There are 3 key ways in which OPEC influences the price of crude oil. Number 1, production quotas and supply controls. OPEC sets production targets for its member countries, which directly affects the global supply of crude oil. By increasing or decreasing production, OPEC can create shortages or surpluses, influencing the oil price accordingly. For example, cutting production typically raises prices due to reduced supply, while increasing production can lower prices. Market sentiment and speculation. OPEC's announcement and decisions, example production cuts or increase, significantly impacts market confidence and investor behavior. Even the anticipation of production cut or increase can lead to price fluctuations as traders adjust their position based on expected supply changes. And thirdly, cooperation with non-OPEC producers. OPEC sometimes collaborates with major non-OPEC producers like Russia, for example, through the OPEC Plus alliance to stabilize or influence prices. Joint agreements on production cuts or increase can have a broader impact on global oil prices, reinforcing OPEC's influence on oil prices. I hope by now you understand how to read into the inventory data of crude oil and also develop a sense for OPEC meetings. All the principles of technical analysis, be it candlestick patterns, support, resistance, trend lines, volumes, can also be applied on crude oil. If you're new to technical analysis, then I would highly recommend you check out our videos on technical analysis to get a good start. While we are talking about crude oil, it also makes sense to touch upon natural gas. Natural gas is also a very actively traded commodity on multi-commodity exchange. Like crude oil, natural gas is also available to you in two variants, the natural gas contract and the natural gas mini. The quotation for natural gas is in MMBTU, which stands for Million British Thermal Units. The lot size for natural gas contract is 1250 MMBTU and 250 MMBTU for natural gas mini. Contract value is about 4.5 lakhs for natural gas and about 90k for natural gas mini. Margin for both the contracts is 27.25%, which translates to a margin amount of 1.2 lakhs for natural gas and 25,000 for natural gas mini. Expiry cycle for natural gas is pretty much the same as that of crude oil. Just like the way you read inventory data of crude oil, you can also read the inventory data of natural gas on investing.com. EIA releases the natural gas inventory data on Thursdays 10:30 a.m., which translates to 8 p.m. India time on every Thursdays. So do watch out for volatility on every Thursdays 8 p.m. in natural gas contracts. One common misconception that traders have is that crude oil and natural gas is highly correlated. But this is not true. Crude oil and natural gas has a correlation of 0.58, which is not considered high. The factors that influences natural gas is slightly different compared to crude oil. Here are a few factors that influences the price of natural gas. The weather conditions in US, industrial and residential real estate demand in the US, geopolitics, especially in countries where large natural gas pipelines run. Needless to say, you can of course apply technical analysis on natural gas as well. Another important thing to note, which is common to both crude oil and natural gas. You can get spread benefit by initiating a long and short position simultaneously. For example, you go long on natural gas mini and short on natural gas. Or you go long on crude oil mini and short on crude oil. Do explore the margin calculator to figure out the exact spread margin benefits. I hope you found this video useful. If you have any specific queries related to crude oil or natural gas, then do comment below. I'll be happy to get back with a response. Happy trading.